Hello, everyone. Welcome to another episode of Capital Insider. I'm your host, Ellie Perlman, and I want to talk to you today about the three futures, how essentially different rate scenarios that are pretty much dictated by the Feds can change your decisions on what to do with your investments, what to do with your money. Just a quick disclaimer, I'm not an investment advisor. I never was. And so take everything that I say with a grain of salt. This is just my observation and my, um, I would say recommendations as someone who ran a private equity shop for about a decade or so. And have been through this cycle. There are ups and downs, and a lot of it is directly and indirectly in dic essentially dictated and impacted by the Fed's decisions. And what I want to talk about today is essentially, how does it look like for you as an investor when it comes to three kind of different scenarios? What happens if the Feds keep rates unchanged, if they increase it, if they cut it? How does it impact your portfolio? Whether you want to sell, you want to buy, or just keep holding. How each of those realities changes essentially what happens to your portfolio. We can start kind of, today I'm recording this is July 31st. So a few days ago, the Feds had their latest meetings and their benchmark interest rate hasn't changed. It's still, they kept it steady at 3.5 to 3.75. And, that range has been maintained since January of this year. And I have to say that I'm surprised because I really thought that, especially after the head of the Federal Reserves has, changed, that the new guy, the new sheriff in town is going to be a lot more aggressive and start cutting rates. But I guess I gave the political pressure a little bit too much credit. And in reality, nothing really changed since January, and it's the end of July. That's a really long, I would say, stretch. And I really hoped that at that point, we're going to see consistent rate cuts month over, or basically from one meeting to another. So, the reality is that everyone is affected by the rates. I want to share with you how I see it from my point of view. And the one thing that I am hearing a lot from people, and honestly, I was also hoping for interest rate cuts, but everyone is kind of asking when rates are going to return to normal. And then this is a bit of a contrarian view, but I believe that they already have. The 3% interest rate environment that we were in years ago, that was a vacation. It wasn't normal. It wasn't the standard. And I don't think anyone in real estate thinks that we're going to go back to that. But they were hoping there's something in between where we are now and where we were in 2020, 2021. But if we take a step backwards and we kind of look at where mortgage rates were since 1971. So we have Freddie Mac that essentially tracked all this data. So for the last 55 years, the average mortgage rates for the entire over 50 plus years was essentially 7.7%. So today we're essentially between 5.5 to 6.5%. And that's actually way below a 55-year average of 7.7%. So that puts things a little bit in perspective. It's possible that these rates are here to stay, but also, and I'm going to get to it later, cap rates are what really dictate the valuation of assets, and interest rate is only one factor that impacts cap rates. It doesn't mean that if mortgage interest rates are going to remain, at the level that they are today, that valuations are going to remain the same, because I actually think the valuations are going to go up in a few years. But it's always helpful to start with kind of seeing the benchmark of the last 5 decades, 7.7% mortgage average interest rate. We are 5.5 to 6.5%. So it kind of puts, things in perspective. Now, when I started today's episode, I talked about three scenarios. So one scenario and this is also where Blue Lake, the company that I run, is essentially new acquisition. So as a buyer, you want to buy new assets. Obviously, if interest rates are lower, then a lot more deals pencil because LTV is not 50%, which makes it harder for deals to make sense because you need a lot more equity. And so when interest rates are favorable, meaning they're lower, then you can buy more deals. And the contrary, the contrary is also correct. Or when you have higher interest rates, then fewer deals actually work out. Cost of debt is higher. You need to pay a lot more in debt service, and that eats into your cash flow every month. But also, the LTV is much lower. So if you're trying to buy something at 45, 50% LTV, many times it's very, very hard to make the deal, work. The second scenario is the other side of the spectrum is if you want to exit. Generally speaking, when cap rates are compressed, meaning they're 3.5%, 4%, 4.25%, for instance, it means that usually you have a lot more buyers. And the prices that you can get per unit, per asset is a lot higher. And then when cap rates essentially expand and they're higher, many times it signals a smaller buyer pool that the prices are going down. And it's a little bit counterintuitive because this is what's happening now. Cap rates have essentially expanded. There are fewer buyers, but the prices are lower. So one would think, okay, if prices are lower, then more investors would want to buy real estate. And that is actually the right way to think about it. But there are other reasons why other buyers don't want to buy, even though prices are lower. And we see 2000 plus vintage assets that are trading at $100,000 to $150,000 a door. Great prices that we haven't seen in the past. We're looking at deals that are trading at 50, 60% discount to the peak in 2021 to how much the current seller purchased the assets for. And so we are actually bullish on multifamily because we see the opportunity, and it's kind of a window which I think would close in the next 2 years where you can buy assets at a discount. That window is going to get closed. But this is kind of the other scenario if someone wants to exit and sell their assets. And in between, if you're an investor that has, your assets that you want to hold, then the changes when it comes to interest rates really impact your refi opportunities. If you have a certain loan and let's say you're paying 4.5%, valuation of the assets needs to go up significantly for you to replace that loan with a higher interest rate today because you can't finance at a 4.5 fixed rate. And so those three scenarios, buying, selling, or holding, they're very, very different scenarios. And we're going to dive into each because the impact is very different when it comes to each of them. And so let's look at the first scenario, which is what's happening today. Rates, they stay flat. When it comes to new acquisitions, I can share with you that yes, more deals pencil out compared to a few years ago. And usually you get 3 to 4, maybe 4.5% yield day one if you're buying multifamily, if you're buying value add or light kind of core plus deals in growing markets. But in order to justify buying in today's environment, there really need to be a decent business plan, and you have to believe that you can push income and grow it year over year. Otherwise, it really doesn't make sense. If NOI remains the same, you're not really making any money. So when it comes to new acquisitions, it really depends on the business plan and your ability and conviction on how much you can essentially grow the income NOI, grow and implement the business plan. Now, if you're on the other side of the spectrum and you want to exit, then interest rates right now are not very helpful. So, essentially you don't have, like I mentioned earlier, a tremendous amount of buyers. And one of the reasons is that a lot of buyers are still waiting for interest rates to go down so their deals would pencil better. And even those who come to the table, many times this is not, as a seller, this is not the price you want to see. And obviously, if let's say there's a significant rate cut in a couple of months, and now interest rates are, and this is of course my dream, right? 4.75, 4.5, which very unlikely to happen, but crazier things have happened, especially in real estate. Then all of a sudden, a lot more buyers are entering the market. And as a seller, you have a bigger pool. Now we're back to bidding wars, and you can maximize the amount that you can essentially sell the asset for. Now, if you are an investor that wants to hold their portfolio, if you have obviously fixed rate loan on your assets on your portfolio, then directly you're not being impacted, right? Whether it stays flat, it goes up, goes down, you've already locked in the rate years ago. It would impact you indirectly, and I've seen that before, where when interest rates are going up, and that means that your tenants are paying more for, to maintain the same lifestyle, and then some of them may have an issue paying their rent on time. So you do see an uptick in bad debt in some markets. But again, this is kind of an indirect impact. Also, your services and the cost can go up. So if you're renovating units, now paying those vendors and contractors to bring materials, to perform the work, everything costs more to them. And so that cost, or at least part of it, is being forwarded to us as owners. So there is some indirect impact through rent collection that we can see in rent collection, and also in expense management. Now, for investors that have floating rate assets, that's essentially, if you don't have, as an investor, a rate cap in place that would have a ceiling to your interest rate payments, then of course you would be impacted by just paying higher interest rate than you did a couple of years ago when interest rates were lower. And so it really depends what kind of type of debt you put on your portfolio and your assets. And so that's kind of how keeping the rates flat impacts you differently. So if you're in a buying mode and you're buying real estate like Blue Lake does today, then you just need to make sure you still buy, but make sure that you can increase that you're confident you can increase the income. And if you want to sell, just, if you don't have to sell right now, I would hold and wait for interest rates to go down. And if you want to refi, that's, and keep holding your assets, it's going to be extremely hard to do in today's environment. Now, let's move to the second scenario, which is what every real estate investor wants: for rates to drop. Let's say they drop 100, 150 basis points, meaning they drop to 4.5%. So now, if you're in the first scenario of buying assets, now you need to move fast because you have a lot more competition. I remember 7 years ago when I was competing for assets, I was submitted an offer with 30, 35 other groups. It was crazy. Everyone was racing to buy multifamily, and many times we lost the deals because we weren't willing to pay the highest price to win it. So that was very hard to win deals back then. It's probably not going to be as crazy, but if interest rates are going to go down, then the window for buying all these assets on this, and the fire sales that we see today, that window is going to close. And many investors are going to be back in the market. A lot of institutions, a lot of dry powder are going to move to multifamily again. And so that's when prices are going to go up, because now your interest rate, the debt cost is lower, then you don't have to bring as much equity to invest it to buy, and your returns are higher because you don't have to pay as much in interest rates. So, between 5.5% and 4.5%, that's real money. especially when you're looking at 30, 50, $60 million deal. So those who are buying right now before interest rates go down and prices go up, they're going to be the biggest winners. They're going to look brilliant. And I'm sure that this time, is coming. Now, if we're looking at the other side of the spectrum again, if you want to sell your asset, then now that you're on the other side of it, of the table, you have a lot more buyers that are competing. They can they can offer a higher price because they have more yield and it does make sense to them. So sometimes deals, valuations and offers can jump from 40 to 50 to 55, $60 million. It's that, I would say, extreme. And this is just movement in debt payments that can really change things for a lot of owners that, I would say once interest rates start dropping, maybe second or third time, then it's the time to put some of the assets in the market. Many times it's not even the yield itself, but it's the indication that the economy and interest rates are going in a certain way. Because when investors cannot predict what's going to happen, they tend to sit on their hands and not invest. And I always say that the confused mind says no, and the uncertain mind just doesn't do anything. So once you see, it's not even how much interest rate is being cut, but it's a consistency of one decision to cut rates, a second decision to cut rates, a third decision to cut rate. I think that by the third consecutive decision, that's going to be a signal to the market that real estate and the economy is strong, that interest rates are going to go in a certain way, and that predictability would move investors to essentially buy real estate. Because many times it's the lack of predictability and uncertainty that makes them not invest, not really the terms. So even if deals pencil out at 5.5% interest rate, the fact that they don't know if the feds are going to decide next month to all of a sudden increase rates, that is not really helping. And a lot of investors are shying away from it. Now, the third scenario, if you're deciding to hold your portfolio and interest rates are going down, this is where essentially it is the time to make the move and refi if you can. So if you have fixed rate, obviously you can consider refinancing. You have to run the numbers to see if it makes sense. If you have 5% fixed and now it's 4.5%, maybe it makes sense. Maybe it doesn't. Usually you need a significant delta to make the move. If you have, floating rate debt, sometimes there will be a decrease in your debt payments, but many times you need a significant rate cut in order to feel the difference. But refi would be amazing if you can put new debt, but you have to also make sure that valuations are high enough, because if you swap a 5% loan with 4.5% loan, but the first one is 75% LTV, the second one is, let's say, 64% LTV, the loan proceeds from the new loan may not be enough to cover the old loan. So it's not as simple as, hey, I have I have a 50 basis points or 100 basis points lower debt, I can just swap it. Depends what LTV they're allowing you and what is the baseline valuation, because that essentially dictates the loan proceeds. Now, the third scenario, if you stuck with me until now, that's good. The third scenario is that interest rates are actually going up. Let's say they're going up to 6.75 or 7%. Remember, it's still lower than the 7.7% average mortgage rates in the past 55 years based on Freddie Mac's information. But if that happens, there's almost no new acquisitions. Nobody is going to buy real estate right now. What happens is that lenders that are underwriting those deals, now loan proceeds are down significantly. So now you need more equity to buy the same building. And when you do, yield is just going down. So now you can look at 2-3%, 2.5% cash on cash year over year for 7 years. Doesn't really make sense to take that risk. So many times this kind of paralyzes the market and you don't buy. So And we're not going to buy if, interest rates are going to be, extremely high unless valuations are going to go up. And we'll talk about that in a minute. And then, of course, if you are the seller, just don't sell. Just wait until interest rates go down because unless you've held the assets for 15, 20 years, most likely you're not making any money. You're selling it maybe at a loss, maybe for a slight profit. And if you have enough cash flow to pay your debt and keep hold and wait until interest rates are going down. And for those of you who have an active portfolio, if interest rates are going up, then if you have fixed rate loan, you're a winner because you locked it in for a much lower price. And that's what happened to us when we had a 3.5% fixed rate loans on assets that we later sold. We were able to sell it at such a high price because a lot of the buyers underwritten it with the 3.5%, not with the 4.5, 5% that were at the time, because they were assuming the loan, they were stepping into our shoes and taking over. So that allowed us to essentially maximize the sale proceeds because they were tied to the old debt that did not exist anymore. Of course, if you have a floating rate and interest rates, go up, hopefully you have a rate cap that kind of caps the amount that you pay every month. Otherwise, you're paying a much bigger ticket every month. And I know some owners that got into trouble because of that. They did not have a rate cap and their debt just spiked tremendously, and that put a lot of pressure on their portfolio. But like I've alluded to earlier, cap rates can definitely compress even without falling interest rates. And there's kind of a misconception that if interest rates goes down, cap rates compress and go down also, and vice versa. And it might be true, but it's not the entire truth because if we look at data, if we look at history, cap rates have not always been correlated with interest rates. There are other factors that impact cap rates, and this is something that many, many investors miss. And I think it's really important to talk about it. If you're looking at the cap rates in the past, you had multiple points in history where cap rates went one way and interest rates went the other way. So, one example, for instance, is in the mid 2000s, the Feds increased interest rates, but cap rates fell anyways and they compressed. Between 2004 and 2006, the Feds, they essentially raised rates by more than 4 points. But cap rates actually went down, not up. So the reason for that is that at that point between 2004 2006, there was so much capital chasing apartments that buyers just accepted lower yields because they wanted to buy real estate. So there was another factor that was stronger than interest rates, and that was the availability of cash. And I definitely actually see that there's a lot of dry powder. And equity didn't just evaporate. Some of it did if assets were in trouble, but there's a lot of dry powder, especially institutional money, that is out there still waiting on the sidelines. So the moment that capital is going to move, that could be stronger essentially than any movements to interest rates if that capital is willing to accept lower yields. So if, for instance, now the new reality is 11% IRR project level or net to investors, then that money is going to be invested regardless of any increase in interest rates. Another time in the history when that happened is that in the early 80s, apartment cap rates sat below the treasury yield for about 5 years, 5 consecutive years. And apartments appreciated 6% a year, even though cap rates were kind of below the treasury yield. That was really interesting because investors accepted less yield than the government bond on purpose. And that was because apartments protected them from inflation, but bonds didn't. So that's another example in the history where, essentially investors there was availability of cash, and that cash decided that they're either willing to accept lower yield, or they want it because it provides them something beyond yield that they valued, such as protection from inflation. So if someone is saying today, cap rates are too tight, to treasuries, they must go up, the history shows us multiple times that it wasn't necessarily the case. Now, besides interest rates that can still have an impact, but then you have on rate caps, but then you have the availability of cash. Rent growth is the third essentially factor that can impact cap rates. And that can be all by itself as a single source that can impact cap rates. So since 2022, new construction of apartment buildings throughout the US are down over 40%. So you have less new supply that we're going to experience in the next 3 to 5 years, because there's nothing else that is coming really in significant quantities in a pipeline. And we know because we see how many permits are being submitted, and it's a fraction of what it was compared to the peak of 2022. When you don't have a lot of supply, and this is a simple supply and demand concept, then you can increase rents. And that's what is almost certain to happen in the next 3 to 5 years, in my opinion. So many times buyers are willing to pay more today for income that they believe that is going to show up in year 2, in year 3, etc. When the market starts to turn and rent growth is going to be something that investors can capture. When that happens, then cap rates essentially go down regardless of what's happening with the Fed. So we already know that there's not going to be new supply in the next 3 to 5 years. And it's probably in different markets, for instance, in Phoenix, it probably is going to take 2 to 3 more years until we are going to see a decrease in new construction. In other markets, it's already happening. And the end tail of the new construction is going to be probably in the next 12 to 18 months. And once that happens, rents are going to start growing. When rents are going to start grow, then when a buyer underwrites it, they see a tremendous upside, yield is going up, etc. So regardless of what the interest rate is going to be, let's say I am underwriting to 7% fixed rate, right? Because interest rates, went up. But in that hypothetical scenario, I strongly believe, and sometimes we can already see, the rents are going to grow, let's say 6%, which is still very high year over year for 3 years. That alone can overpower and overcome a higher interest rate, because we still have positive cash flow and the valuation of the asset increases to such a number that an exit is going to be very lucrative. So besides interest rates, you have availability of cash. And once the cash wants to be deployed, it's willing to take lower yield, and rent growth that can change the economics of a deal to be profitable, even though interest rates are higher. So really you have 3 factors that impact cap rates. And the fact that interest rates are going up, it doesn't, or staying steady since January of this year, it doesn't mean that valuations and cap rates are going to remain the same. And I already know of some assets that we personally passed on that were sold at 4.5% and 4.75% rate cap in the last 3 to 5 months. So if the buyer that was willing to offer a high price believed in rent growth, or they had capital they had to deploy and they were willing to receive lower yield, that could be one of those 2 instances where that specific buyer chose to essentially offer a higher price, even though interest rates were, kind of much higher. And that can be extrapolated to an entire market in 6, 12, 18 months. So that's essentially, why I actually think that that cap rates will compress in the next couple of years, regardless of what's going to happen with interest rates. But obviously, it's definitely going to help if interest rates are going to go down because we already know the rent is going to grow in the next couple of years, and you still have the availability of cash. So we have actually 2 out of 3 factors that are very solid in getting stronger in the next year or so. Rents are going to grow in many markets because construction is going down, new construction, new supply is going down. You have a labor that needs to be deployed. You have 2 out of 3. And I believe that over time, in the near future, those 2 factors would overcome steady or slightly higher interest rates. Now, once the Feds turn this policy and start cutting rates, then you have 3 out of 3, and that's going to increase valuation, increase competition, and prices for multifamily. But I just, wanted to share kind of my thoughts. And again, I know some of it is a bit contrarian because when everyone is kind of running towards something, I would be more hesitant and vice versa. And someone smarter than me said that before in different words. But that's essentially what is happening in real estate. So it's a fascinating period right now where that almost not almost every purchase, but many purchases right now, we're locking in prices at a huge discount. 5 years from now, 3 years from now, you're going to look back and you're going to say, these guys were geniuses for buying those assets. But it doesn't feel like it because, on the other hand, the impression is that the market is not ready yet because interest rates are higher. But those who are looking past fear, past the need for consistency, for predictability, are the winners. Because guess what? When you have predictability, when you have consistency, and you're more comfortable, you're paying a premium for it. And the premium is higher prices. So that's it for today, guys. I hope that added some value. I'm happy to answer any questions that you have. If you want to reach out to us, email us to info@bluelake-capital.com. That's it for today. Thank you, and I'll see you on the next episode.